Jersey Mike's. They tell me it's a sub above.
It's a Jersey Mike's thing, a sub above.
Founded in 1956, this little sandwich shop from the Jersey Shore grew into a multi-billion-dollar success story, enjoyed and loved by millions of Americans.
Slide it through. This is what every bite should look like. Outstanding.
But now it's caught the eye of Wall Street and private equity. The Blackstone Group, one of the largest private equity firms in the world, just bought Jersey Mike's for a whopping $8 billion.
If it's Mike's way, it's Steve's way.
But here's the thing. In the world of private equity, financial success doesn't always mean what you think. Because what if I told you Wall Street could actually make money even if the company they invest in fails? It's true. And Jersey Mike's, they might just be their next victim. Now, before we dig in, let's talk about what private equity even is. Private equity traces its roots to the mid-20th century, when wealthy investors and institutions pooled capital to acquire and restructure underperforming companies. But by the 1980s, however, fueled by cheap debt and aggressive financial engineering, private equity transformed from a niche investment strategy into a dominant force on Wall Street. Firms like KKR and Stephen Schwarzman's Blackstone Group, the largest of the private equity giants with over $1 trillion in assets under management, pioneered the art of acquiring companies with borrowed money, loading them with debt, and extracting massive profits. One of the most famous deals? The $31 billion takeover of RJR Nabisco, a deal so ruthless it became synonymous with corporate greed and excess, even inspiring a best-selling book and a Hollywood movie. Other high-profile victims of private equity include Toys R Us, Payless Shoe Source, and Sears, all once iconic brands that have now vanished from the retail landscape. And the playbook is almost always the same. The acquired companies are loaded with debt, and the private equity owners extract value through management fees, asset sales, and dividend payouts. In layman's terms, private equity firms charge fees for just owning the company, then they sell off all the valuable assets for quick cash, and sometimes they even force the companies to borrow more money and use that money to pay themselves bonuses. Hence the nickname vulture capitalists. And the most sinister part, even if the company fails, the private equity funds almost always come out ahead, leaving workers, customers, and communities to pick up the pieces.
I've had 24 shrimp.
I ate 51 shrimp.
I ate 50 shrimp.
The endless shrimp promotion has now led to Red Lobster filing for Chapter 11 bankruptcy.
All you can eat shrimp, no more. Some news outlets are reporting that the restaurant's $20 all you can eat shrimp deal cost them millions.
Endless shrimp deals.
Endless shrimp, all you can eat.
The chain and its parent company, Thai Union Group, reported an $11 million loss in the third quarter. And Thai Union says the shrimp deal was a key factor in that impact.
Yes, it was the all-you-can-eat shrimp that sank Red Lobster. Or was it?
Red Lobster for the seafood lover in you.
Founded in 1986, Red Lobster was one of America's most popular and profitable seafood restaurant chains. In 2014, however, a private equity group called Golden Gate Capital acquired Red Lobster for $2.1 billion. Then they proceeded to ransack the company, making deals to sell off Red Lobster's real estate for $1.5 billion, and then forcing the company to lease back these locations at inflated rates, which is a textbook private equity move to extract quick cash for investors. Then in 2016, Golden Gate Capital sold off 25% of Red Lobster to Thai Union, one of its largest shrimp suppliers, and eventually they sold the rest of the company in 2020, meaning now you've got a seafood restaurant chain run by a shrimp supplier, with the main strategy being to sell as much shrimp as possible, even if it meant sinking the business. After years of financial struggles compounded by the COVID-19 pandemic, along with increasing labor and food costs, the company filed for bankruptcy in May of 2024 and abruptly shuttered roughly 50 of its locations across the country without informing employees who showed up to work only to find signs announcing their restaurant had closed. But guess what? By then, Golden Gate Capital had already cashed out, pockets full, business stripped, and on to greener pastures. So here is private equity's playbook exposed. I will show you just how exactly private equity always makes money, even if their investments go bankrupt. Let's use Jersey Mike's as an example. Step 1. Leverage. When Blackstone buys Jersey Mike's for $8 billion in cash, most of that $8 billion doesn't come directly from them. Much of that money, up to 80%, is made up of loans from other banks. This is what's known as a leveraged buyout, or an LBO. In this case, if we assume an 80-20 split, Blackstone will have used only $1.6 billion of their own money and borrowed the remaining $6.4 billion from other banks, which in theory would be fine because we buy things with debt all the time. For example, a house. We pay a down payment, and for the rest, we take out a mortgage funded by the bank. But the big difference here, and this is where things start to get a little sketchy or a lot sketchy, is that the acquired company, in this case Jersey Mike's, is responsible for repaying the $6.4 billion of debt, not the private equity firm. Step 2, collect fees. A lot of fees. Private equity firms typically charges its investors a 2% annual management fee on the total fund. For the sake of simplicity, let's say this fund is $8 billion. That equates to $160 million collected by the private equity firm each year, regardless of how well the investment actually performs. It's money for doing absolutely nothing. Step 3, strip assets. The acquired company usually owns some valuable assets, whether it be real estate, equipment, or maybe lucrative patents and other IP. The private equity firm can sell these assets to generate quick cash, often to the tune of hundreds of millions, if not billions of dollars. And the cash generated often doesn't go into improving the business, but is instead used to pay themselves and their investors a special dividend. So in this hypothetical scenario, Blackstone could go into Jersey Mike's, see what's valuable, sell off assets, let's say $1 billion worth, which leaves them only a few $100 million short of their initial cash outlay, which means in a lot of these cases, the money generated through these asset sales is enough for the private equity firm to already break even on their investment. And the most sinister part of all this, private equity often sells these assets to other companies in their own portfolio, which means that they're making money on both ends of the deal. No joke, they really can do that, and in fact, deals like that aren't uncommon at all. Step 4, cut costs. To keep the business afloat long enough to extract more value, private equity firms often impose aggressive cost-cutting measures. For instance, they might lay off 20% of the workforce, reduce product quality by sourcing cheaper materials, or sometimes even defer critical maintenance to cut costs further. And while these cuts may boost short-term profits, they often leave the company weaker and less competitive in the long run. But if they can keep the company alive for just a few years, say in the case of Jersey Mike's, with a net profit of approximately $100 million for the next 3 years, plus adding in their 2% management fee, 100% of their initial cash will have been extracted. Step 5, the exit. The ideal scenario is the private equity firm selling their investment to another buyer or taking it public through an IPO. For example, if Blackstone is able to sell Jersey Mike's in a few years for $9 billion, they'd be able to pocket $1 billion in profit on top of their earlier dividends and fees. But what happens when there's no exit? Well, if the company collapses and goes bankrupt, that's okay too, because like we talked about, the private equity firm usually at this stage has already made its money back from fees, asset sales, and dividends. And if you're wondering what happens to the $6.4 billion loan that they took out, that's the bank's money, not private equity, so they don't have to worry about that. And don't worry too much about the banks. They're usually fine too. Senior debt holders, those at the top of the lending hierarchy, are often made whole during liquidation as their loans are secured against the company's most valuable assets. Mezzanine debt holders, slightly lower on the ladder, also have a good chance of recovering their investments, though with slightly more risk. Only the most junior debt holders who accepted higher interest rates for greater risk are likely to face losses. So in summary, no matter what happens, the private equity firm gets paid, the banks get paid, but the employees, well, let's just say they're the ones left holding the bag. With all that being said, I don't think the private equity model is inevitable. It's a choice. And earlier this year, I had a chance to sit down with Tiffany Cianci, a small business advocate, to ask her, how can we as regular Americans take on private equity behemoths like Blackstone?
Everyday Americans can do a couple of things. One, lift up the small businesses in your community, seek them out. Don't look for the shiny marketing, don't look for the glossy ad campaigns. listen to referrals from your neighbors. Look for people that are on social media just trying to get a foothold. Don't look for the ones with the big followings, right? Go find the small businesses and lift them up. But you also have to ask hard questions. If you're looking for a vet, ask, have you been acquired by private equity? Who owns you? Who owns you? Ask that when you're going to seek out a business. Don't be afraid to ask it, right? Do those small things. And for businesses that are being acquired by private equity, stop giving them money. It's hard to believe that that's the best course of action, but it is.
That's right. Today, it may seem like private equity's grip on our economy is unbreakable, but change begins with awareness, action, and a commitment to divesting from the global and investing in the local. The power, I think, is truly in our hands. That's it for me this week. Let me know what you think about private equity, about Jersey Mike's, Blackstone. Sound off in the comment section below. If you want to support this kind of journalism, please take a second to like this video, share with as many people as you can, subscribe to my channel, and hit that notification bell so you can be the first to know when my next video drops. Also, check out my new merch store. And as always, I'd like to thank you for your time, and I'll see you in the next one.